Welcome back to Morning Markets on Monday, the 17th of January. On screen, we can see the key market moves from Friday. The key takeaways: global equities were positive on the day, led by a recovery in US equities. Government bond yields moved slightly higher, with a more pronounced move in US Treasury bonds after US retail sales print was published. That came in slightly softer than expected. However, it was a month where Omicron infection rates were picking up and spenders were acting slightly more cautiously. There was also evidence that consumers had actually been spending on goods for the holidays earlier than usual, given the ongoing discussion around supply chain challenges. Therefore, it's understandable that there was a slight month-on-month moderation there. The US dollar was slightly stronger on the day relative to a basket of international currencies. If we look at sterling relative to the dollar, that was down around 0.2% at 1.37. As we look to the week ahead, the US equity and bond markets will be closed today for public holiday. However, the rest of the week in the US, there'll be clear focus on the earnings season. So that's the earnings season for the final quarter of 2021. This week we'll hear from big banks, including the Bank of America. We'll hear from Goldman Sachs, Morgan Stanley, along with a number of the US airline providers. The reports are important because market participants will be paying close attention to the detail and the commentary around those factors which have been feeding into the inflation backdrop, including cost of transportation, raw material prices and wages. We anticipate the challenges which businesses have faced through 2021 and that final quarter will be highly discussed. But what we're really looking for here is evidence that these challenges in terms of supply chain disruption are starting to ease and that business outlook remains positive. It's often in the interest of business to try and moderate expectations as they look into the earnings season, but it's very worth noting that against the backdrop which we've seen, US companies are expected to report stellar final earnings for 2021. The expectation at this stage is for earnings growth in the final quarter north of 21%. If achieved, it will reflect growth in earnings of 45% for the year 2021 versus 2020, demonstrating the improvement which we've seen in business health. So far this morning, we've received the Chinese economic growth data for the final quarter of 2021. The reports demonstrated the economy grew at an annualized rate of 4% in the fourth quarter, so that was ahead of expectations of 3.6%. Economic growth for 2021 therefore came in at 8.1%, again ahead of expectations and that government expectation of 6%, the majority coming from a pickup in domestic and international consumption. To maintain momentum in economic growth, the People's Bank of China cut borrowing rates for medium-term loans by 10 basis points to 2.85% and very short-term reverse repo loans by 10 basis points. So ongoing evidence that China, the People's Bank of China, is very much in policy easing mode. In Tuesday, we'll have the interest rate decision and the quarterly economic update report from the Bank of Japan. The minutes will also be published for the December meeting. Tomorrow, we'll receive the unemployment reports here in the UK, and by Wednesday, we'll receive an update on the inflation prints. Thank you very much for watching, and we look forward to bringing you up to date throughout the week on all of these subject matters here on Morning Markets.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.